So guys, it's been a pretty rough stretch for the stock market lately, and if you've checked your portfolio at all this week, you probably don't need me to remind you. The S&P 500 is down 5.6% just in the last month, and year to date, it's down over 3.5%, so not a great start here in 2025. And in my portfolio, we're also seeing some red. In the last month, the portfolio is proving to be a bit more resilient than the S&P, but still we are down in the red by about 0.8%. Year to date, though, things are still looking good. And despite all the craziness in the market we're seeing right now, I'm still up almost 5%. Now, from what it seems like, a lot of the turbulence we've been seeing in the market here has been tied to new leadership here in the United States and the ripple effects that have come from that. More recently, though, and more specifically, the market's latest sell-off has been driven by the implementation of new tariffs, which has seriously spooked investors and has sent share prices heading south. Now, I get that drops like this can be scary in the moment, sometimes to the point where it feels like the sky is falling. But when you take a step back and zoom out over a longer period of time, you'll realize two important things. First, the market can't go up forever. It just doesn't work like that. Corrections, sell-offs, and periods of volatility like what we're experiencing right now are inevitable. They just come with the territory of being an investor, and this won't be the last time you experience something like this. Second, despite the fact that you can't avoid this periodic turbulence in the market, history has shown us time and time again that things have a way of working out. Yes, there are days or weeks or months or even years when it seems like the stock market is out to get you, but there are also days when it's your best friend. And prior to this, that's what we experienced. Things were really good in the market. And when you zoom out and look at the big picture, it has been much more rewarding to investors than vengeful. Through all the wars, recessions, crises, interest rate changes, and other expected events, the US economy and stock market have persevered. And those who've stayed the course through the highs and lows have found it to be wealthily worthwhile. And that's one of the things about investing over a multi-decade period. You have to have a certain level of faith in turbulent times like this to remind us of that. You have to believe that things can be better tomorrow than they are today, both for the overall market and for the individual companies you own. You have to believe that despite short-term hiccups, great businesses will continue to grow over the long haul. Having said that, as we're entering this more turbulent period, now would be a great time to take inventory of your holdings, revisit the financials, and make sure the businesses you own are in a strong position to weather whatever challenges might come next. If everything looks to be in good shape, then there's really not much of a reason to panic. If you're a dividend investor, that's even more true because when you invest in dividend-paying stocks, not all of your returns are tied to share prices going up. No matter what's happening in the market on any given day, those dividends will just keep rolling in, unless a company cuts their dividend, of course. But otherwise, that makes times like these much easier to stomach, at least in my experience. Even better, reinvesting that steady stream of cash flow while share prices are down allows you to buy more shares at lower prices while locking in higher yields. And that's the real silver lining here, guys. When share prices go down, opportunity rises. The stocks that you own or the ones that you've been wanting to buy go on sale, offering more attractive valuations with a greater margin of safety and higher potential returns moving forward. And in my case, guys, while there are a plethora of different stocks that I would like to buy, there are three in particular that I'd really like to hone in on if things in the market continue heading south. The first of which, guys, is going to be Visa. I've said it before and I'll say it again. In my mind, Visa is like the gold standard of stocks. And out of the three companies we're talking about today, Visa is the only one that I already own. If we take a look at my position, we can see I have almost 24 shares and an average cost of just under $270 per share. And with the current share price sitting at about $343, that's going to leave me up about 28% on a total return basis. And my goal with this position was to make it the largest individual stock position in my portfolio. We can see it's number 2 behind Starbucks, and it is so close, guys. They are pretty neck and neck here, as we can see. But I did hit the pause button on buying Visa a while ago because the share price was just starting to get away from me. And by the way, guys, the platform that we were just looking at was Snowball Analytics, which is actually the sponsor of today's video. This is a really cool portfolio tracker that I think you guys would like a lot. They're actually running a really big sale right now, and I want to tell you a little bit more about it. One of the most essential tools for any investor is a solid portfolio tracker, and Snowball Analytics is like the Swiss Army knife of portfolio trackers. I've been using this platform pretty religiously to track my own portfolio for a while now, and I'm extremely impressed by just how much insight it provides into my portfolio. As you can see, the layout is very clean and intuitive, and I found the platform pretty easy to navigate. Plus, it's packed with more charts and graphs than you can count, which speaks to just how much insight it offers not only into your portfolio, but also at the individual stock level as well. I mean, pretty much anything you want to know about a company's financials or dividend history can be found here within the platform. Now, in my opinion, what really sets Snowball Analytics apart are the features that it has specifically designed for dividend investors. I'm actually convinced this platform was made for us, and here are a few of my favorite features. First off, Snowball tells you your total returns by default throughout the platform, which may sound like a small thing, but it's crucial for dividend investors because it doesn't neglect the dividend income we receive when calculating returns. Most other portfolio trackers will only show share price returns, which is really only half the equation, so it's refreshing to see dividends calculated into these calculations. Additionally, Snowball also has a pretty robust event calendar that keeps you updated with upcoming news, events, and dividend payments. They even have a dedicated dividend calendar so you can see who's paying each month, when they're paying, and how much they're paying. And then another favorite feature of mine is Snowball's backtest tool, which lets you see how your portfolio stacks up against the S&P or any other benchmark across multiple time periods. And once again, dividends are included in the calculations, which is awesome. And beyond these tools, Snowball also offers a community feature where you can check out other users' public portfolios to see what others are investing in, which is always a fun thing to look at. Plus, they have stats for stocks and ETFs that show what's trending and popular among other investors. This makes Snowball not just a killer portfolio tracker, but also a great place for dividend investors to get new investing ideas. So overall, if you're looking for a great portfolio tracker, which once again is something that every investor needs, then I highly recommend you check out Snowball Analytics, which you can actually do for free. All you need to do is click the link in the description of the video or in the pinned comment, or just scan this QR code right here to get a 14-day free trial. And if you like it, right now you can save 30% on your subscription with their spring sale. I've personally really enjoyed using Snowball Analytics, and I know you will too, so definitely take advantage of that spring sale and save 30% on your subscription. But anyway, guys, getting back to it, like I was saying with Visa, the problem with this stock is that it's just gotten a bit too far away from my cost basis, and I'm not sure I'd want to add any more shares until we see some sort of pullback in the share price. And taking a look at the share price performance, we can see it's kind of slowly starting to get there. It's not seeing as much of a pullback as plenty of other stocks out there, but still today it's down over 2%, and the share price has gone from a peak of about $365 per share just a few days ago to where it's at now, about $343 per share. And this is going to leave it down about 1% in the last month. And if we zoom out looking at the year to date, this is still going to leave Visa up quite a bit. It's still up 9% here in 2025, so it has some more room to come down for sure. And truth be told, guys, I'm not asking for anything too crazy here with Visa. You know, I'm not asking to see like a 50% pullback in share price before I start buying or anything like that. Although I would load the boat if we did see prices get that low. But, you know, if we saw Visa get to maybe around $300 per share or so, somewhere in that range, I'd probably start adding to my position again. And what can I say, guys? I just can't help but love this company. I mean, if we look at the financials here, taking a look at these growth metrics, the revenue, earnings per share, and free cash flow per share, it really doesn't get any more picture perfect than what Visa's got going on here. Everything is straight up and to the right at double-digit CAGRs, mind you. Revenue's growing at about 13% every year on average, earnings per share closer to 19%, and free cash flow per share is growing the fastest out of the three at about 26% on average every year for the last 5 years. So to me, this is pure class. This is a real work of art. And I think you'd be hard-pressed to find financials that look any better than what we're seeing right here. And then scrolling down, another thing that I love about Visa is the very squeaky clean balance sheet. We can see that they have about $8 billion of net debt on the balance sheet, but when we compare that to the company's free cash flow that they're bringing in, that $8 billion is nothing at all. Actually, the net debt to free cash flow is 0.47. And because the net debt to free cash flow is less than 1 here, this basically means that Visa has more free cash flow coming in per year than they have debt on the balance sheet, which is obviously a good thing. And if things in the economy do head south in a meaningful way, this is the exact kind of business you'd want to own, one that doesn't have to worry too much about their debt. And then looking at the dividend stats, this is another bright spot for Visa, although I will say the dividend yield isn't anything to write home about. It's only 0.6%, which is actually below the company's 5-year average yield. And we can see that with the meteoric rise in share price recently, that dividend yield has really come down. And that's another reason why I wouldn't mind seeing lower share prices from Visa, just so we can lock in a higher dividend yield. Like if we could get it up above 1%, that would be very sweet. With that though, what Visa lacks in yield, they certainly make up for in dividend growth. We can see they have a very consistent dividend growth history. And on average, over the last 5 and in 10 years, we're getting double-digit dividend growth CAGRs. Actually, it's higher over the 10-year period, closer to 20%, but still the 5-year period's not bad. 15% on average every year. I'll take that. And then if we scroll down just a little bit looking at the payout ratios, the dividend is very well covered. So, if things in the economy do head south, I'd be surprised if we had to worry about Visa cutting their dividend, because there's just so much room to continue growing and paying this dividend right here, both in terms of earnings and free cash flow. So all of these things lead me to believe that we're looking at a very high quality business with Visa. This is the exact kind of company I'd want to own more shares of, and this is why I'd want to make it the largest individual stock position in my portfolio. So that's what I'm looking to do here with Visa. We'll see what happens with the share price from here, but I'm hoping it goes down, and the same applies to the other two stocks we're talking about today. With the next one being Rollins, guys, ticker symbol ROL, which I think is another very high quality business. I call this one my great white whale because I've been chasing Rollins for at least a couple years now, and I have been very patient with this one. They say that good things come to those who wait, and I certainly hope that's true, because Rollins has seemed to be trading at such a high premium ever since I started talking about it, and I would love nothing more than the opportunity to buy it at much lower prices than where it's sitting right now. Diving a bit deeper into the share price performance, it is down 1.4% today, so we will take that, but still in the last month, the stock is up 3.5%, and if we zoom out looking at the year-to-date performance, it's up over 12%, and that's just been how things have gone with Rollins so far, guys. I feel like the share price, I mean, it's got its hiccups, don't get me wrong, but I feel like it just does nothing but go up, and when I first started talking about the stock, it was probably somewhere in the low to mid 30s. And even at that point, I thought, it's still a bit too expensive. I'll wait for it to come down a few bucks, which was such a mistake, guys. If I could go back in time and redo that whole thing, I totally would. And I'd own Rollins by now. It probably would be one of the largest positions in my portfolio. And looking at these growth metrics here, the revenue, earnings, and free cash flow, you can see why I would want to own a company like this. Like we saw with Visa, everything is just up and to the right, also growing at double-digit CAGRs, except for the free cash flow right here. But revenue is growing by 12% every year on average, earnings per share is growing by 16% on average, and free cash flow per share is not too far below 10%, 9.3%, still a very respectable growth rate. And if we scroll down looking at the debt situation, Rollins did see a pretty big jump in debt between 2022 and 2023 right here, so they definitely took on a bit more debt there, but still, it's really not all too concerning because the net debt to free cash flow is only 1.25, which basically means that if they dedicated all of their annual free cash flow to paying off that net debt, it would only take them about 1.25 years to do so, which is really not too bad. My rule of thumb for the net debt to free cash flow for a company like this is like 5 or below, and Rollins is well within that threshold, so I think it's still in a fine spot. And then scrolling down looking at the dividend stats, guys, this actually looks better than what we saw with Visa, in my opinion. We're getting a higher starting yield first and foremost, coming in at 1.2%, which once again is not the highest yield, but still, at least we're getting 1% here. And the 5-year dividend growth rate is actually higher than what we saw with Visa, coming in at about 17%. Now, scrolling down, one area that Visa has the advantage over Rollins is in the payout ratios. We can see that Rollins' payout ratio is much higher, above 60%, which, is a bit on the higher end, I will admit, but this does look to be consistent with where the company's payout ratio historically has been. It's pretty much always sat above 60%, so this seems to be normal for the company. And now, guys, jumping over to my watch list here on Snap Stock, which is actually a new feature, guys. It's not out yet. We're still working on it, but I'm excited to give you a little taste of what it looks like here. But anyway, kind of what I'm looking for with Rollins at this point is somewhere in the low 40s, which, as we can see, it is still so far away from that. So we're going to need a pretty serious pullback. But if it gets down somewhere in this range, I'll start a position and we'll gradually build it out from there. But in reality, I would love to see Rollins go even lower. I mean, like I said a few moments ago, when I first started talking about this stock, it was in the 30s. So I would love the opportunity to be able to buy it at that low of a price, but I just don't know if it's going to get there, guys. That seems to be so far away from the current share price. So if it hits somewhere in the low-ish 40s, I'd be happy. Anyway, now moving on to the third stock of the day. This one is Old Dominion Freight Line, and I've been talking about this one a bit more lately, and this one is probably the closest to where I'd want to buy it. We can see that as opposed to Rollins, it is actually down quite a bit in the last month. Old Dominion's down about 9.5%. And if we look at the year-to-date performance, is also in the red. It's down 1.3%. And not only that, but the share price is actually down quite a bit from some of its earlier highs. It looks like mid-February is around $210 per share. So right now it's quite a bit below that, which I certainly welcome. And despite what's been happening with the share price lately, guys, when we look at the growth charts, we'll see that just like the last two companies, Old Dominion has been a pretty solid grower over the years. Looking at the growth metrics in terms of revenue and earnings per share, we can see that although for the most part the charts have been up and to the right, there has been some stagnation these last couple of years. Looks like 2022 to 2024 have been, a bit stale for Old Dominion, but that's not so much been the case with the free cash flow. We do still see a little bit of free cash flow per share growth here in this time. And even so, the CAGRs are still looking pretty good. I mean, the 5-year CAGR on the revenue is 9.7%. For earnings, it's about 6%, a little bit lower. And for cash flow per share is a little bit higher than earnings at about 8.4%. And if we scroll down looking at the debt, one of the great things about this company is that it actually has negative net debt on the balance sheet, which means that it has more cash on hand than it does outstanding debt. And that is one of my favorite things to see, guys. I love when a company has negative net debt. It's just one less thing you have to worry about. You don't have to worry about Old Dominion going bankrupt anytime soon. And then out of the 3 companies we've looked at so far, Old Dominion's dividend growth has been the most insane. I mean, the dividend yield is more akin to what we saw with Visa, about 0.6%, which is a bit above the company's 5-year average yield, which is not much of a surprise considering what the share price performance has been lately. But looking at the dividend growth, guys, it's just been unreal. The 5-year CAGR here is 36%. I don't know if I've ever seen a 5-year dividend growth rate that high. And if we scroll down looking at the payout ratios, we do see an upward trajectory right here, but still it's not bad. The earnings payout ratio in the trailing 12 months is less than 20%, and the free cash flow payout ratio is still about 26%. So plenty of dividend coverage here. But anyway, guys, we'll see what happens from here. I'll be excited to buy some of these stocks if I can. I think they're all fantastic businesses. And in this next video right over here, I'm telling you about 3 more stocks that I think are kind of the opposite. To me, it looks like dividend cuts could potentially be on the way for these 3 stocks here. I'm kind of concerned about them. So click right over here to find out which ones they are, and I'll see you in the next one.